even if you want to use a buyer's agent like me, general rule of real estate is never trust anyone in real estate. The biggest myth in commercial is long vacancy periods, which is correct if you buy the wrong asset, but that's also correct with residential if you buy the wrong asset.
Majority of doctors will end up owning some sort of residential property, if not more, but majority of people don't own commercial property.
The reason residential is lower risk is because there's less areas to stuff up on. I kind of use the analogy of like a staircase. With residential, there's only 3 or 4 things you generally can trip up on. So you buy the wrong type of asset, you accidentally buy in a flood zone or an easement through your property that you didn't know about. There's a few things you got to check. Commercial, you have all that plus a big list of things. So it's a much bigger staircase to fall down on. No steps are hard. People think because there's lots, it's complicated. Each step is very simple if you know how to do it.
Hi everyone, welcome to another episode of the Investing for Doctors podcast. I'm your host, Dr. B. And today we have with us Steve Palisi. Steve, welcome.
Thanks for having me on, B.
So Steve is the founder and owner of Palisi Property and best-selling author of Commercial and Residential Property Investing Made Simply. That's a picture of the book right there. And he also recently released a free 10-hour course on commercial investing, and we'll feature that in the link below. So Steve, welcome. And tell us a bit about yourself. What was your background and how did you come to being who you are today?
Funnily enough, I actually got into James Cook University for a doctor, but I chose engineering instead.
Oh, so, okay, cool.
I just didn't think I'd get through university. I'm not good at memorizing. I'm really good at concepts.
Yes.
And then applying concepts, less at kind of rote learning, which I know being a medical professional, it's not just that, but there's a part of university as that. So I did engineering. So I did robotics engineering. Mm-hmm. So did that through uni, then started designing like robotic limbs. Actually worked for a company called Welch Allen as well.
Oh yeah, Welch Allen.
Which did diagnostics equipment.
Stethoscopes.
So I was a biomedical engineer for them.
Yep.
Then I sold my soul a little bit and went and worked for mining because it paid about 3 times as much and did that. But while I was doing that, as working my way up through the internship and kind of stages, I started buying residential properties. And then I think I had about 6 or 7 under my belt. And then I had like friends of friends getting me to help them. And then all of a sudden I was like, well, I'm doing this most of my day anyway, staying up to 2 a.m. looking at properties. Why not make it a full-time career? And now we're 7, 8 years down the track, 2,000 deals under my belt. And then I've purchased now 1,200 residential and about 800 commercial. And like I said, 2 books now in stores. So yeah, bit of a career change.
I hear you have a 3rd book coming in?
3rd book coming out in February. So I got development, property investing explained simply. So now it's like, for me, like, funny enough, I wrote the commercial book first.
Yes.
And then everyone started bottlenecking me as the commercial guy, saying, oh, Steve's just going to try to sell you commercial because like that's what he does. And I'm like, no, I started in residential. Residential has a lot of value. So then begrudgingly, I wrote the residential book. And then we decided recently, let's close out the series and give everyone like the full picture of how they can do wealth, because residential is good for a base, commercial is good for cash flow, development's good for acceleration. So now at least you're making an informed decision.
Excellent. So as you're a buyer's agent, you're national, I presume. What kind of properties do you do? What kinds do you not do?
We buy anything that makes good investment sense.
Yes.
Hence why we do the 3 books. Yes. And everyone's circumstances are different because it's what you're trying to achieve over what time frame versus what finances you have to allow. Generally, we don't buy like high density or off the plan. So everything's got to have a good solid land component and have good supply demand kind of ratio between it, because we want to buy stuff that gets capital growth. And then the type of asset will be based on what your goals are. If you're looking to build a passive income quickly, commercial's a good option. If you're looking to buy a net wealth base and passive income for now isn't a big thing, then residential. If you're looking to make lots of profit on a deal in the short term, in 12 to 24 months, then development's an option as well. But we buy anything that has good fundamentals. But I think the main focus today is about commercial, isn't it?
Yeah, I'm going to pigeonhole you a little bit. So
No, but I want to give people the concept that like commercial has huge benefits, which we're going to talk about today. Then it's also got some negatives as well, and that's where residential and development come into play.
I mean, you already touched on some of the differences between residential and commercial. Commercial tends to be more cash flow driven, and residential tend to be more sort of net wealth building. Explain a bit about that, and obviously some of the pros of going to property investing.
Okay. So the main difference,
commercial property
the main difference with commercial is you literally get 3 times the cash flow typically. So like we often buy 6-7% net yields. And I emphasize that word net yields because people compare that to a residential yield. The reason it's net is because commercial tenants pay all your outgoings. So they pay the council rates, the water rates, insurances, property management, maintenance. So if you buy $1 million asset with a 6% net yield, you get $60,000 income at the end of the year. That's kind of what you get. Residential, you're typically looking at most markets now 4% as a max, and that's a gross yield. You still have to pay council rates, water rates, that. So that actually erodes down to generally around a 2% net yield in regards to cash flow. So I'm getting 3 times the cash flow. So for most people to say, well, why not buy commercial? Like it's thing. And that's where some of the negatives come in. Also where some of the myths come in as well. So the biggest myth in commercial is long vacancy periods, which is correct if you buy the wrong asset. But that's also correct with residential if you buy the wrong asset. You buy a high density apartment in an oversupplied area, vacancy rate's really high. It normally comes from a misconception from one asset class. So they'll see like an office space that's been vacant for a long time and say, oh, don't buy commercial, it's like really high vacancies. Industrial vacancy rates are between 1 and 2% at the moment, so that's really low. And then retail, they'll look at some shop that they saw as being vacant for 5 years and say, don't buy retail. But a GP clinic that they go to every single 3 months has been there for 10 years, and that can be still a good investment. So there's nuances with that, but on average, if you know what you're doing, I can actually argue that it's a lower risk. And I'll go into it now. So let's say we buy a $1 million residential versus a $1 million commercial. The commercial on average, probably around 6% net yield, you'll be around 20 grand a year positive with a mortgage. The residential, you're going to be 20, 30 grand a year negative. So if I buy something with a 5-year lease with guarantees on that lease, in 5 years time, I've got $100,000 in my pocket ready. So even if I have a vacancy, I can probably handle that mortgage for another 2 or 3 years before it's. So as long as I buy less than 2 or 3 year vacancy, I'm okay. Typically it'll only be 1 to 2 months if you buy the right asset class. With residential, if that's 20, 30 grand a year negative, in 5 years time, I'm actually down $100,000 to $150,000. So now there's 250 grand disparity in my cash flow, but they'll say that the residential's lower risk. The reason residential's lower risk is because there's less areas to stuff up on. I kind of use the analogy of like a staircase. Like if you're walking down a staircase with residential, there's only 3 or 4 things you generally can trip up on. So you buy the wrong type of asset, you buy like a off the plan or a high density, you accidentally buy in a flood zone or an easements through your property that you didn't know about. Or like, I don't know, you might buy in a housing commission or the house is riddled with termites or something. So there's a few things you got to check. Commercial, you have all that plus a big list of things. So it's a much bigger staircase to fall down on. You've got lease reviews, contract reviews, tenant interviews, road and traffic analysis, vacancy study, occupancy study, competition analysis. You got to talk to town planners, property managers. Like there's quite a lot more involved with commercial, and that's where most people get fearful. So first one is the vacancy, and it's true if you don't know what you're doing. If you do know what you're doing, it's actually not a risk at all. It's actually a positive. You can actually work it to your advantage. So that's myth number one. The next one, capital growth. They'll say commercial doesn't grow the same. If commercial didn't grow the same, how did it get expensive? On average, if it's got a land component, so it's something like a suburban retail or an industrial property, it has exactly the same capital growth. So,
I mean, the land beside the residential.
That's right. The land value is where most of it comes from, not the building anyway. And as long as you've got like something in demand, they happen out of cycle a little bit, and that's where the myth comes from, or the misconception from different types of assets. They'll say, well, office space doesn't grow, therefore commercial doesn't grow. Apartments don't grow the same as houses. So I don't say don't buy residential. So people kind of encapsulate all of commercial as one, but it's not. There are so many types.
Yeah. So, I mean, I guess also, the other thing is that commercial property comes in so many different shapes and forms. There's, as you said, the retail, there is the office, there is industrial, there is even boutique stuff like petrol stations and single occupancy, standalone medical practices, or even a day procedure center, for example, or a hospital, right? So I mean, it's a whole range of that.
All got different road traffic, like foot traffic, demand in that type of area, different infrastructure going around it.
So if I were to reframe it, there's probably also less pricing opportunities within commercial real estate. So you don't actually see that growth, whereas you see in residential, because there's so much volume happening. And there's a lot more visible because people tend to go around looking at that.
Yes and no. The problem with commercial is most people don't know how to understand how to evaluate a property. And that's the
fair
hard
enough.
thing, because with a house, you go on realestate.com and you look at what all the other 3-bedroom houses.
Yeah.
That's right.
Yeah.
But say you're buying a warehouse, and even if it's a body corporate warehouse, you have to work out square meter rates first before you can even evaluate that property. Then you need to look at the percentage of office space versus mezzanine area, then the access and how many car spots does it have, and does it have an overhead crane? There's all these ones. That's just for industrial.
It's harder to value.
That's
it's
right.
harder to value.
It's a lot harder to value. You also just can't go on realestate.com and get the information.
Exactly.
You can barely even do it on Core Logic. So even where you get the sale price, you then have to click into the actual property and look at photos and work out what the areas are and things like that. And that's just for industrial, and that's the simplest type of property. Medical, for instance, that's even harder, because like one that's a couple suburbs away is completely different to one where you're buying. It's got different road traffic, foot traffic, things like that. And then retail as well gets even more complicated, because the valuation on a GP practice actually has a different net yield to a cafe, which has a different, and the stability of the tenant plays into it as well. So it's not harder. There's just more things you need to do to actually say it's a good investment.
More complicated.
It's more complicated.
Yeah.
But no steps are hard. That's what I want to point out. People think because there's lots, it's complicated. Each step is very simple if you know how to do it.
Yeah.
Like if you say to someone, check if your property's in a flood zone for residential, that seems hard, but once you know, just go to the council website.
That's the council website. There's a flood map. There's a 100-year, 1,000-year flood map.
There's always something like that for commercial as well, but you're only doing 3 or 4 of those things on a residential. Commercial, like we've got 100 checkpoints that we actually go through, and you can download this on my website. It's a free download of going through all that stuff. Even the documents you typically get around 100 documents to verify when you buy a commercial property as well. You get P&L statements, rental ledgers, insurances, check the leases are registered. Like there's quite a lot to it. So there's more steps involved, but the rewards are there. As I mentioned before, you get the same capital growth and you get 3 times the income. So performance-wise, you get a much better return on investment. The negative is you don't get as big a leverage.
Yes.
You can't get 90, 95% loans.
Yes.
Typically 80% for most, 70% for the rest of them. If you're going lease stock, which we can maybe talk about a little bit later, it's another type of loan where it's based on non-servicing, it's based on the property itself, then it's even less. So you need more capital to get into it. So you're sacrificing leverage.
The barrier to entry is higher.
Yeah, barrier to entry is higher. But it depends what you're comparing it to as well. You can buy a very quality $1 million warehouse. If you're living in an area that the houses are 2.5 mil, I'd actually say that's a lower barrier to entry. Even if you're getting an 80% loan and you were going to buy a residential on an 80% LVR anyway, same. Why not consider a commercial? But again, it's assessing why you're buying it. Someone like me, I'm all about passive income. I've built my net wealth. Now it's about lifestyle and keep traveling and doing all that. Some doctors want to go part-time. Other ones just want to match their income so they can retire. And some doctors just don't know what they're doing. They just want to buy good investments and reap the benefits.
Yeah, beautiful. So you mentioned Lease Stock. Explain a bit more about that.
All right, so you've got conventional lending. So that's where they look at your servicing.
A full document.
Yeah, full doc. So they'll look at basically what your income is, what your expenses are. They'll apply shading criteria. So they'll add extra interest rate on, typically the 1.25 to 3% extra interest rate. They'll take 80% of the occupancy, so they'll take 20% of the rent off, and then they make sure you can afford that. So that's typical shading criteria. So you still got that with commercial, so full doc servicing criteria. But then there's also a loan product called Lease Stock. So if I buy a property on a 5-year loan, they'll give me a 5-year lease. They'll give me a 5-year loan based on the rent of that property. So they look at that in isolation, and then you can get a loan based on that, which generally means you can keep buying without servicing. The difficult thing is getting the capital for the deposit, because you need a bigger deposit, because that property needs to wash its own face with the rent. So if I'm buying a 6% yielding property and the interest rate that I'm getting is 7%, that's where they reduce the LVR to make sure that it's positively geared and it can look after itself, knowing that you can service that property. But the cool thing about that is if you've got a lot of equity or you're selling properties, you can buy quite a lot of commercial and basically 3 times your income.
Yeah, so I mean, you can also do some equity releases on your existing residential, and if you have that sitting around.
Which is what most people do, they're part of your strategy. But again, it depends on your risk profile. Me personally, I'm selling my residential portfolio, except for some with granny flat potential, and transferring it into commercial because I want the passive income now. I also want to reduce the risk as well. So even though theoretically I could have extracted equity, my LVR is 50% and I'll actually be debt free in 7 years time. And that's part of just my mental state of like, this is quite refreshing having like a $500,000 passive income debt free. But again, that's just me. Goals change as well. Like when I first started this game, first goal was get to $100,000 passive income, then it was 200, then it's 500. Now I've got kids and then the bill of private schools will come into it. So everyone's goals shift. So it doesn't have to be a definitive plan as well.
Yeah, beautiful. Yeah. So tell me about the process of, say, engaging someone like yourself to buy a commercial property.
The first thing is just to reach out. So like have a strategy chat. Most people don't know when commercial's right for them. Actually, I'll rephrase. I'll flip this around a little bit. I'll tell you when commercial's wrong for you, because that normally answers the question when it's right for you.
Let's do that.
So commercial is wrong for you when you're early on in your journey and you've got leverage on your side. So if you can get 90% loans or even 80% or doctors 95%, I would much rather go out and buy 3 residential properties on 90% loans versus 1 commercial on a 70% loan. Because if I get the same capital growth, like I mentioned before, 3 times as equity. We've made 3 times as much. So that means commercial is wrong for you at that point in time. If generally you don't have the capital to get into a good commercial, then that's not worth it. If you come to me and you've got, I don't know, $500,000 for commercial, but we've got $800,000 for residential capacity, we'll probably do with that. And then the other one is if you're a high income earner and buying positive geared isn't a part of your strategy at the moment. It's just wealth creation and you want the negative gearing strategy, that'll come into it. But generally where commercial is right for you is if you've got a short-term passive income goal or you're at the end of your servicing with residential and you kind of have to buy there. So it's just matching up with your finances with what you're actually trying to achieve and then going from there.
Would people, who is a typical person that would come and say, okay, you know what, I just can't be bothered dealing with residential. I've got my home now. I just want to go commercial.
Typical general client is someone who's got 2 or 3 residential.
Yeah.
And it's not so much they don't want to deal with it. They know the banks aren't going to lend to them anymore.
Okay. So serviceability is often when they go to commercial.
Is often the driver.
Yeah, I see.
Or intent of stepping away from something or wanting kind of to release the handcuffs to say. So like a lot of doctors they actually say, I want to go part-time, but I want to make up that difference with investing. So me buying them a negatively geared property, that doesn't help the strategy. Like that's actually locking them into working even more. So then we'll actually shift. So even if they didn't have, say, residential, or I didn't think they had a large enough base, buying a negatively geared asset's not going to help their goal. So we actually go commercial. We had a doctor last year where he's about to retire. He was 63, I think, and he wanted to retire. And he had the funds there. And we actually sold a couple of his Sydney's properties. They're about $2 million each. And we actually bought an $8 million shopping centre with 22 tenants. 20 tenants. And then that's his thing, because like we've had big deposit, high cash flow. I think it was about 300-400 grand a year positive, and that's him done. We've reduced the risk because we've got lots of tenants, even though theoretically we probably could have bought a larger base for residential, but that didn't make sense for him. He wanted to retire. So it's working out that part of what you're actually trying to achieve and then matching up with it. You can do well off both investments.
Yeah. So I guess the trade-off is that you putting in a much higher initial deposit amount.
Which is the negative for investing. For property investing, the whole advantage of why I love the asset class is they'll give me big money. Like I can put in 10, 20% and someone will lend me 80% to buy something big. So I reap the benefits of that if it does well. Counter argument, if it doesn't do well, you actually lose big as well, which most people don't talk about. So this is why buying safe investments and why I won't go out and buy high risk commercial. Everything I buy has to be good tenant, long lease, low vacancy rate region, versatile premises as well, because even if it's low vacancy, you will lose your tenant at some point, whether it be 5, 10, 20, 30 years. You want the premise to be versatile as well. So I always buy what I call boring commercial properties. So just ones that I know I don't have to worry about. I'm always going to replace the tenant. And versatile. I'm not going to go out and buy a client a car wash station. Yeah,
give me an example of like a really, really boring
industrial property. Boring
warehouses.
Whereas lots of comparables. Versatile. Can be a car mechanic, wholesaler, kitchen cabinet maker, distribution center, can be storage. It's just 3 concrete tilt-up panels and a roller door.
So it's basically a shed.
It's a shed.
Yeah, it's a shed that you can use for anything, any purpose.
It's just open space.
Yeah.
And then it's also easy to get comparables, because if I'm buying, say, a body corporate $1 million warehouse, I can look at every other warehouse in that complex, what it rents for per square meter, what it's sold for per square meter, the ones that went vacant, how long they were vacant for. Then I can go to the adjoining complexes and do the exact same thing. So I can actually get a list of 20 20 comparables in the last 2 or 3 years and make an educated decision. And if most areas we buy, we're talking 1 to 2 months maximum vacancy. So if you buy this property and it goes on average vacant every 7 to 12 years for typically like a $1 to $2 million warehouse, and you're having 2 or 3 months vacancy, it's still positively geared that year.
Yeah.
And then you're back to square one. Something like a retail, for instance, you get the tenant for longer because the profitability of that tenant is based on that location.
Yes.
So if it's, let's just say, a hairdresser, if that hairdresser does really well and we find a hairdresser that we want to buy and they're really profitable, they won't close up shop and move to a bigger hairdressing salon. They'll open another salon.
Yes.
Whereas an industrial property, they don't want to have 2 locations. Logistics doesn't work, having trucks going to different locations. So they're locked in for the life of the business. The only time they'll ever leave is when the business fails. However, it's not 1 month vacancy for a retail. It's typically 6 to 18 months, but the average tenancy period is 10 to 20 years. So it's that balance of like short 1 to 3 month vacancy, but every 7 to 12 years, or 10 to 20 years, but a longer vacancy period. And then there's no right answer for that. Like some medical centers, for instance, like they'll be there for 30 years, hopefully, but you'll typically pay a premium. You're not going to get a 7% net yield with a GP clinic. So it's assessing the risk and reward.
Yeah, beautiful. And you mentioned there's some more sort of exotic options. What are examples of that?
It's anything specialized that only has, we're very one-dimensional. You can't
single purpose?
Yep, single purpose. Yep. Cinemas, car wash stations, petrol stations, anything that's you can't do anything else with. Once it basically stops that business, there's a big cost to correct it. Banks also don't like them as well. Like you won't get an 80% lend on a petrol station. You'll need a high deposit, so there's risks there. But one of the other things I think is worth talking about is one of the myths with commercial is people say there's no value add opportunities. They say, well, we can't do anything with a commercial. You're right if you're buying an office space, but if you're buying a freestanding warehouse or even a freestanding retail medical center, you can still do all the exact same renovations as you can in residential. You can renovate the outside, you can build second stories, you can build second dwellings. So you've got all that same one, but then you've also got internal value add, which people don't talk about. And what I mean by that is increasing net lettable area. Like if you have a warehouse, let's say you have a 600 square meter warehouse, you can build a 200 square meter mezzanine floor, which is going to get you additional rent. And they're valued based on the rent that you receive. So you increase the price by 33% just by building a $80,000 mezzanine floor. So you've got that option. Then you can split tenancies up and smaller tenancies will rent for a higher square meter rate. So you can increase value there. I go to the physio in Sydney and across the road, there's a fish and chip shop. And it's a fish and chip shop with an ATM machine, a residential property on top, and telecommunications on top of that. So one property has multiple sources of income. It's actually in my book. There's a page on the book about it. So you've got all these creative ways as well. So anything you can do in residential, you can also do in commercial. But again, more nuances, more things to understand. We bought a property in Perth last week, and we've got an advertising board that we put on the side of it. It's a retail showroom type one. So it's like effectively an industrial property, but they can run retail premises out of it because it's got the glass frontage. On the side of that, we put I think it's a 6x4 meter advertising board. Get $100,000 a year rent just from that. $100,000 a year rent. Just because there's I can't a lot of road traffic that goes past. So there's that you can't. Well, theoretically, doing residential, it's a lot harder to find an adequate property for it.
So it sounds like there's so many more little tips and tricks and variables
but don't let that keep you away. I actually, in my portfolio, I buy very boring properties, like ones I don't do anything with. Like I just bought a shopping center. It's like a suburban shopping center in Brisbane. 8 tenants, 3.1 million. It's just got the typical boring hairdresser, cake shop, cafe, IGA. Like it's just the usual tick the box one. I'm not planning to do anything with that. It's just a nice net return, safe net return. Just keep it in the long run. Because it's freestanding, I know down the track there's a value add, but that's the same as buying like a big size residential as well. You could theoretically build a block of apartments or whatever it is. But I'm not buying it for that. I'm buying it somewhere to park profits of my business and portfolio into something secure that I know is going to pay itself off in the next 5-10 years.
I mean, I guess one has to think what they're doing for the investments down the track to actually build up that portfolio and
it's just the purpose of what you're buying. And like a lot of people, like the most common client I get is they say, I want freestanding, value add potential and a good tenant. I go, well, that's kind of counterintuitive because if you're getting a really good tenant, you're not going to do the value add. If you've got a 5 year lease term, so they're theoretically locked in for 15 years, you can't do anything for 15 years anyway.
Yeah.
So why not have spent a little bit less and buy like a different asset that has no value add and have some left over to buy another property? So it's a lot of people, they do the same thing with residential. Oh, I want granny flat potential.
Yeah.
Like you don't have to buy them. You can just buy the bread and butter. Most of my portfolio is stuff I'm never going to touch again, but it has capital growth, it's got the cash flow, and it ticks the boxes.
Yeah, yeah. And who do you typically get to run these manage the property? You just get a local?
Yeah, you always generally get a local property manager, similar to residential, because they know the market. It's a bit harder to choose a commercial one because there's nuances and things like that. We'll obviously make recommendations because we've bought lots of properties. We know who's good or not. The annoying thing is they won't actually know if they've got a good property manager until you lose the tenant. Because I'm buying good quality commercials, theoretically, there's going to be no issues because we've checked that the tenant pays everything on time. We've gone through 2 years of rental ledgers. We've checked their profitability. We've checked competition analysis. While they're there, if they just keep paying on time, you don't have to worry about it. It's easy days. Where the really good property managers come out is when it goes vacant. They do really good experience marketing campaigns. They know the locals as well. They know the waiting list, who wants to come in where. And then they always have a specialization. Some are really good at retail, some are really good at industrial. But same concept as residential. You get a good property manager that looks after the asset. Even though it's easy while it's working, it's not worth doing it yourself. Just even regulation stuff of keeping up to date with the fire code and things like that. It's not worth your time, especially for the doctors where they can make money elsewhere.
And how much do they typically charge, or do they charge that to the tenant? You mentioned
again, you work out what the net yield is. I'd say around 50% of them the tenants will pay. There's certain classes, there's a retail leasing act, so you can't pass on property manager to a retail tenant, but you can with industrial. Most of them charge kind of 3 to 4%. It changes based on the income. They'll want to make kind of 4 to 6 grand a year as a base. Minimum. If I'm buying a $10 million shopping center, completely different to buying one little shop kind of thing. So the shopping center, my personal one's 3 mil, I'm paying I think about 18 grand property management, but they've got 8 tenants. But the similar to residential ones will want to look at 2 to 3 grand. Commercial will kind of be 3 to 6 grand-ish as a kind of an income. All negotiable. That's the fun part with commercial. You can negotiate everything. Besides retail leasing act, it's Wild West. You can put whatever you want on a contract. You can negotiate anything with property managers. You can give whatever incentives you want. Everything is up for grabs because it's private. It's business.
Yeah, it's a business. It's a business to business. It's not regulated like how residential is.
And there's tips and tricks as well. So the one that people often fall into is when they get a new tenant, particularly medical tenants. So say you get a GP clinic or an X-ray center or whatever it may be, they'll say, I'll give you reduced rent at the start while you get up and running. And then they give them reduced rent. Banks value it based on the rent you receive.
Yes.
So you're actually better off giving 3 months rent at the start and then market rent after that, because when you do your valuations, you get a much stronger valuation. So there's all these tips and tricks. But you're not going to know that with residential. It doesn't matter. You charge market rate. You get on with it. There's no incentives. You don't give 2 weeks free rent.
There's none of that variability in the contracts.
And then with the lease, there's different types of guarantees. You've got bonds. You've got personal guarantees, bank guarantees, all this stuff that just kind of goes over most people's heads. So the rewards are there with commercial, but you've got to put in the work as well.
It's more complicated.
Our due diligence reports are about 100 pages long. It takes 30 to 40 hours per property. Our due diligence on residential is a couple hours, because once you've picked your area in your suburb, you've just got to cross-check the criticals. There's
only a couple of things that can go wrong residentially.
Right. But you sort of know as well, I know the suburbs I buy for residential because the fundamentals stack up. I've already done the research. I know the data. Once I've just got to monitor the market and talk to agents. When the property comes up, do the critical checks, the flood zone, building and pest inspection, all that type of stuff, check the housing commission percentage in the street, et cetera, et cetera. Commercial, I've got 5 guys looking full time for me Australia wide, because you might pick the best suburb that you like, property might not come available for 6 months. And then it might be out of your budget anyway. So you have to cast a much wider net. My advice to the listeners is probably, if you are going to go down the commercial and not use a buyer's agent, choose a particular region, not a suburb, region, and then type of asset, so you become a specialist in it. So choose I'm going to focus on Brisbane, industrial, the southeast corridor, or the trade coast, or whatever it may be, and then just monitor that market. But you'll soon see it's a lot more work than residential. It's not a casual sit on the couch at 9 p.m. looking at deals and photos.
Yeah. And I think a lot of people have that difficulty in understanding a lot of this stuff because it's just not readily available to people. People don't talk about it because majority of doctors will end up owning some sort of residential property, if not more. But majority of people don't own commercial property.
There's no. So my book was the first book on the market. I didn't know that. I had to learn all these tips and tricks the hard way, unfortunately. And that's the hard thing. There wasn't podcasts. Now there's no excuse. There's a few other buyers agents doing it. There's multiple podcast series. There's a couple courses out there. So you can get educated in it, but it's just fear that holds people back.
What is the proportion of Australians investors that actually own commercial property?
This is the hard one because you can't actually tell because most people are buying under trusts. So I wouldn't believe the data anyway.
Well, what does the data say?
I don't even know because you can look at like the big like CoreLogic and that, but there's trust, but then there's companies buying, then there's personal. Where it becomes mixed as well is you got to categorize what type of commercial it is. So you can get a lot of big macro data. So if you go to like CBRE, Savills, Knight Frank, they do quarterly reports on the market. So they do retail office and they'll actually give you vacancy rates and they'll give you a map and they'll show you the different areas, what the vacancy rates for say industrial are. When you actually read the fine print, they're actually just talking about 10,000 square meters and above.
Okay, that's right. That's huge.
That's a low one because they're not going to go through every single little one and actually get the data. Then most of the data on CoreLogic isn't actually right anyway. So most of the time it's anecdotal that you kind of do it. But I'll use that big data as a good indication because if the big boys are playing there, chances are the little players around it will want to be nearby as well. But again, I would say just from my experience, again, this is just a thumb suck, that it'd be less than 150 owner commercial. But the tides are changing. 5 years ago, if I mentioned the word to commercial to anyone, they looked at you blankly. I used to tell people, the tenants pay all the outgoings, and they'd like eyes would light up being like, no, that can't be right. Like, surely they don't pay all the outgoings. Now, because there's education out there, the conversations are different.
Changing.
Which, funnily enough, I actually think is going to be an indicator for growth because if there's 10 times more people willing to buy properties, they're not building 10 times more stock. So it's actually increasing the demand, which I actually think it's not a good long-term projection, but it's a nice indicator that for the next 5 years, we might have a good run.
That's very interesting. And give me some of the like a recent example of something you bought. You mentioned you bought something in Perth. Tell us a bit more how you found it. And
I've been doing this long enough now that like it's kind of like sort of like some medical specialties. It's a very big small industry. So like in most capital cities, there's only like 10 or 15 prominent agents, and I've worked with all of them kind of thing. So for now, like the way I structure my team is I have one person in each state, and all they do all day, every day is just talk to agents. So we get about 70% off market, but ignoring that, you can still find the ones on market. And you just got to have your ear to the ground. So you find out what's coming up. Then you got to do a preliminary due diligence to make sure you're paying the right price. Then you go into contract subject to like the detailed due diligence where you spend 14 days looking at everything. But the biggest one is actually just connections. And I hate to say it because I'm a buyer's agent, it sounds like I'm selling to people, but our offers typically get put to the top of the pile because they know that the buyers are vetted. We've already spoken to brokers when they're educated. The bigger thing as well is if we find something wrong with the property, we also know how to fix it so the deal can still go through. Whereas a lot of like first time buyers will get scared. They'll find like the mezzanine's not approved. And then part of that is like, oh, I don't want to buy a property with an unimproved structure, and they'll just crash the deal. Whereas we know we can send a certifier over, we can extend settlement, we can get a price reduction. Like if it costs around 12 grand to get a mezzanine approved retrospectively, people don't even know that. So we might.
What is that for the?
So if it's already built there, you can then get like surveyors to come in and check that it's built to code, and then you do the council approval. And so you pay your 10, 12 grand to get it approved. So you feel you get approved. And if I'm doing that, I might negotiate $50,000, $80,000 off the price. So all of a sudden I'm going to get it approved myself, and we're going to save $50,000, $80,000 getting that. The other option is to extend settlement. So say, okay, we're happy to buy this still, but we want that approved, and we're going to extend settlement until it's approved. And that's typically going to be like a 3-month process. So we know the workarounds if we've got a good quality property. The cool thing about commercial, if you don't like it though, the third option is just crash. Like if we don't like it, we crash, we lick our wounds a little bit, and we might spend a little bit on like a building and pest inspection or evaluation. But in the grand scheme of things, losing a couple grand and buying a dud investment's not the end of the world. You move on to the next one. We buy quite a lot though. We're buying a lot of suburban retail because since COVID, that's doing really well.
It's doing well,
Industrial is probably the bread and butter, 60, 70% of what we're getting. It's just, especially for first time investors, they can get their head around it. It's not as hard an investment. But I like some value add opportunities as well, because like I mentioned before, if you can increase the value as well for a client, especially an aspiring investor that wants to build quickly, it's just a nice, easy way to accelerate. Same as doing a development in residential, I suppose.
Okay. So, I mean, it sounds like, look, I mean, anyone can get into commercial investing. It seems to fit the people who are already leveraged out, no serviceability anymore, but can get into the door with a large enough deposit.
There's always exceptions. I probably shouldn't say this on film, but like a lot of business owners obviously don't want to pay a lot of tax. So they've got a lot of income in the business, but they're not showing much servicing. So they're not paying the high salary. And they've also primed for commercial as well, because they can, as opposed to paying themselves a higher income and paying 50% tax.
They can do a business-to-business loan. And,
So they
purchase with another
exactly right. So there's always exceptions to it.
I mean, it's about jigging the structures.
Right.
And
whereas they theoretically, and then this is where a good accountant and financial advisor come in. You might actually decide, okay, we're going to buy a commercial or residential, and you rejig the numbers to make it suit of, okay, we can get a loan, and then you go back to doing what you're doing before. So there's always lots of ways to skin the cat, but just like I said, it's always the purpose. Why are you buying the investment, and why is it the right decision over residential or commercial or doing a development project?
Yeah, it's ultimate to fit who you are and where you want to be.
And risk profile.
Yeah, absolutely. So Steve, thank you for shedding some light onto commercial properties, and I think we have you back in a couple of sessions just to have a panel and to talk a bit more about commercial properties. So
sounds fun.
Before you go, any final words?
Well, final words.
Yeah, it's always a hard
one. Get educated for commercial. Even if you want to use a buyer's agent like me, the general rule of real estate is never trust anyone in real estate, because there's always an incentive. There's always an incentive. I'm going to get paid for my service. I get paid whether I buy you a dud or not. I won't buy you a dud because I want you back for number 2, number 3, number 4.
You got a reputation as well.
I got a reputation as well. But a lot of real estate people don't care about the reputation. It's a quick buck. But I actually find the people that get educated and read the books and listen to the podcast are actually much better clients as well, because when you send them a 100-page due diligence report, they actually know what's going on. They actually ask the right questions. Whereas if you're not educated, like there's just too much stuff, like getting a 100-page report and not understanding how leases work, you're just putting all your trust of wealth into someone else, which you should never do, which is the whole point of these podcasts, is to get educated.
Absolutely. So thank you for your time.
Thanks, Ben.
And look forward to having you back in a future day.
That should be good. Thanks, mate.
Thank you. This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.